My name is Raymond from W.consulting, and I'm here to talk to you today about the interpretation IFRIC 21 that was issued in May of 2013 to address the accounting for levies. It addresses the accounting for levies that are imposed on organizations by governments and government departments, government type entities. And it addresses the issue of when to account for a liability that arises in such situations that would normally be dealt with in terms of IAS 37 on provisions, contingent liabilities, and contingent assets. Now, if you look at this particular interpretation, it does not address the accounting for any costs that arise from the recognition of any liabilities to pay such levies. Now, just to go back to the definition of what a levy is. IFRIC 21 defines a levy as the outflow of resources that embody economic benefits that is imposed by governments on organizations in accordance with legislation that exists. However, it does not deal with any situations where you're dealing with income taxes, which would fall within the scope of IAS 12 on income taxes. Neither does it deal with the accounting for any fines or penalties that are imposed on organizations for breaches of any legislation that might be applicable to them. What's also outside of the scope of this particular interpretations are any payments that are made by organizations for the acquisition of an asset or for the rendering of services under contractual agreements with governments and government type entities. And it doesn't deal with any payments that are made in respect of any liabilities that arise from emissions trading schemes in which the organizations may be participating in. Now, there's specifically 6 issues that are addressed in this particular interpretation. And we'll go through these one by one. The first of the issues being, what is the obligating event that gives rise to the recognition of a liability to pay a levy? Now, the interpretation says the obligating event that gives rise to a liability to pay a levy is the activity that triggers the payment of the levy as identified by the legislation. So it's going to be very important to understand what the legislation actually says and at what point it triggers that obligation. So if, for instance, the activity that triggers the payment of the levy is the generation of revenue in a current period, and the calculation of that levy is based on revenue that was generated in previous periods, well, the obligating event for the levy is the generation of revenue in the current period. So therefore, the generation of revenue in previous periods is necessary in order for the obligation to exist, but it's not sufficient to create a present obligation on the company. So if I'm required to make sure that to generate revenue in the current period, but the levy is imposed on me because of the generation of revenue in the current period, well, has that revenue actually been generated? To the extent that it hasn't, well, then there is no obligation and there'll be nothing to account for. That'll be the first issue. Issue number 2 is, does economic compulsion to continue to operate in a future period create a constructive obligation to pay a levy that will be triggered by operating in that future period? So the fact that I may be required by legislation, or I may be required by the operation of contracts that I might have entered into to continue operating, does that in itself trigger an obligation to pay a levy? Again, this interpretation addresses this issue by stating that an organization does not have a constructive obligation to pay a levy that will be triggered by operating in a future period as a result of that entity being economically required to continue operating in that future period. So again, we need to go back to what the legislation actually says, and the obligation is determined based on that. The third issue, does the going concern assumption that all organizations apply, does it imply that an entity has a present obligation to pay a levy that will be triggered by operating in a future period? Again, the fact that I'm preparing my financial statements on a going concern basis does not imply that I have an obligation. Any obligations that I might have will only be triggered by my operations in that future period. So again, there will be nothing to account for. The fourth issue, does the recognition of a liability to pay a levy arise at a point in time, or does it arise in some circumstances over a period of time, progressively essentially? Again, the interpretation in this case addresses this issue and says, well, the liability to pay a levy is recognized progressively if the obligating event occurs over a period of time. So for instance, if the generation of revenue is what triggers my obligation to pay a levy, then to the extent that I've generated revenue so far, then I need to work on the basis of what is sitting in the legislation to work out what my levy obligation is at that point in time and recognize that as an obligation. The fifth of the issues that are addressed by the interpretation: what is the obligating event that gives rise to the recognition of a liability to pay a levy that is triggered if a minimum threshold is reached? So again, you'll find that in a lot of industries, there may be a requirement for companies to pay a levy only if certain minimum thresholds are reached. Well, the simple answer there is, well, has that minimum threshold been reached? To the extent that it has been breached, and at that point, only at that point, does the organization then have an obligation to settle a levy. Now, this leads very nicely into the last of the issues, which addresses the issue around, well, what happens when I prepare interim financial reports? Is the basis for recognition of a liability different in my interim set of financial statements than in my annual financial statements? Here, the interpretation simply addresses this and says, well, an organization is required to apply the same recognition principles in the interim financial statements as it would in the annual financial statements. So therefore, if we come to the conclusion that says, well, we don't have an obligation because we haven't reached certain thresholds, then there is no obligation, there is no levy obligation that should be recognized in the financial statements. You may also find yourself in a situation where you might have prepaid a levy. You might have paid a levy in advance of the obligation actually existing. Well, if that is the case, then the answer is pretty straightforward. The organization would then recognize an asset in the books, essentially a prepayment in its books. Now, this interpretation comes into effect for financial years beginning on or after 1 January 2014. Earlier application is permitted, and application is fully retrospective. Thank you.